Take a look at this chart, right here. This price action sequence forms one of the most reliable candlestick patterns. This is called a tower top, and its bearish equivalent is a tower bottom. A cringe name, I know, but nonetheless, let me demonstrate you just how powerful this pattern is. The tower top is a reversal pattern. Typically, you'll see one long bullish candlestick, followed by a few smaller candlesticks, marking a consolidation, a small period with lack of momentum, and then the pattern is completed with one large bearish candlestick. It usually forms after an up wave or an upward momentum move, and it indicates a slow change in momentum from bullish to bearish. It's very easy to find this pattern. Just look for two opposite color big candlesticks with a small range right between them, usually between 3 to 5 small candlesticks, but sometimes the consolidation could include even more candles. The tower bottom usually forms after a down wave or a downward momentum move, and it indicates a slow change in momentum from bearish to bullish. The first candlestick will be a long bearish candlestick. Several small body candles will follow, marking a small consolidation range. Here, you'll often find small dojis or spinning bottom candles. Basically, you look for candles with small bodies. And the last candlestick, completing the pattern, will be a big bullish candlestick. So what's the psychology behind this pattern? Let's consider a tower top. After a bullish trend, a last big bullish candlestick will form, showing that buyers are in complete control. Then you witness a period of momentum loss. The buyers maybe have used their resources, starting to take their profit, or more sellers will come into the market. At this point, sellers still don't have enough momentum to push the price down. This is why the price will move sideways in a ranging price structure. After a sideways market, a big bearish candlestick will form, showing that sellers took control and the trend has been changed. Now, as always, this pattern can be useless on its own, and you must always consider the market context and what the price is telling you. The simplest way to use candlesticks is with support and resistance levels, or supply and demand areas. Because support and resistance levels or supply and demand areas determine zones where buyers and sellers have set up their defenses, looking at how candlesticks react to them will help you greatly in predicting where price will head next. Let's look at this chart. Here's our candlestick pattern. A large bearish candlestick makes a new recent low and is followed by several relatively small-bodied candlesticks. Then, a large bullish candle appeared, a sign that the flat trend has ended and the potential up move may begin. But more important, look at the location of the pattern. It appeared at a clear support level, at a price level where the previous downtrend was expected to pause. So you have the location, the signal, but when do you pull the trigger? You have several choices. The aggressive entry is right after the large bullish candlestick forms. Another entry method is at the high of this bullish candle. Or you enter when the high of the previous bearish candle is taken out, if this bullish candle is smaller than the first one. And the most conservative entry is after another bullish candle to really confirm the upward momentum. It all depends on your risk profile. Here's a resistance level where price couldn't break above and moved lower. Observe this clear rejection candle, a pin bar. And here's our candlestick pattern, which formed at the previous high. We have one long bullish candlestick, followed by two smaller candlesticks, marking the lack of upward momentum. And the formation is completed with this large bearish candlestick, marking the change in momentum from bullish to bearish. And after this price action sequence, we are left with a double top, which is another bearish indication. The entry is at the low of the bearish candle. I usually place my stop above it, and I look to gain double the amount I've risked. If you're not experienced using only price action, you can add a 10 simple moving average for extra confirmation. The 10 moving average is a short-term one, as it considers only the latest 10 candles on the chart. And you don't need more because you are trading a shift in momentum from upside to downside or vice versa. You want to find the tower candlestick formation and follow the 10 moving average. It's easy. This chart shows a large bullish candlestick, followed by 3 relatively smaller candlesticks. The pattern is completed by this large bearish candlestick, which closed below a 10 simple moving average. This is the extra confirmation that you are indeed on the right side of the market. You want the price to break the moving average. When the pattern is completed, the moving average will help you with managing the trade. You placed a short trade, you set a stop loss above the red candle, and you simply follow the moving average to find the exit point. The 10 moving average can also help you to identify if the market you're in is trending and if it respects the moving average. As long as the price stays below the line, you're safe to remain in the trade. This price action pattern is quite versatile. You could trade it on any time frame you want. Here's a trade on the daily time frame for those of you that don't have much time to trade. As a side note, not every pattern will be a textbook pattern. I would love to find symmetrical patterns, but this is not how the market works. Let's look here. This is a tower formation, but not that obvious. The first candlestick is a long bullish one. Several small body candles followed, marking a small consolidation range. And the last candlestick completing the pattern was a big bearish candlestick. At the same time, we also have a breakout below the 10 simple moving average. Stop loss above the signal candle, and you either set a fixed target of minimum 2 to 1, or you follow the 10 simple moving average and exit your position when price breaks it to the upside. Sometimes, if you use the 10 SMA as a trailing stop, you could catch a giant trade. Now, if you don't find an obvious support or resistance level, or a supply or demand area to take the trade from, pivot points are your best friend. In my opinion, you should never day trade without knowing these levels. You must know at least the central pivot point. Pivots were developed by floor traders to indicate static support and resistance levels based on the prior day's trading range. Nowadays, pivot points are often factored into algos and high-frequency trading programs, not to mention that traders often place stop orders at or near pivot points. And combined with our candlestick pattern, you will pinpoint more precise entries and exits as well. Let's look at this chart, again, on the daily time frame. I must insist to use this setup on higher time frames because it will make trading less stressful and you will have more time to do other things you enjoy. First, we added the standard pivots on TradingView and kept only the central pivot and the first 2 levels of support and resistance. And here's our tower candlestick. Again, not that obvious. First green candlestick, followed by a doji and 2 spinning tops, and a big red candlestick. And more important, the signal appeared right at S1 pivot level. You placed the stop above the large red candlestick. And the traditional way of setting profit targets using pivot points is by taking the next pivot level as your immediate target. Let's move to pound dollar on the 30-minute time frame. Again, an imperfect setup. I insist on showing these signals because in real time, you will waste a lot of time if you're chasing the textbook example to appear. Here we have a big red candle, followed by another small one, and several candles forming a range. But if we merge the two red candles, we get a big red one, which is the first condition in our pattern. The range is obvious, and then we have the big green candle, showing the upward momentum. The signal is located at the central pivot level for the day. Place the stop loss below the green candle. Now, as a price-based tool, pivot points commonly serve two functions. First, to provide multiple price support and resistance levels ahead of time, and secondly, as a simple trend monitoring tool. The main pivot point should theoretically get the most action when tested, and as we are in a bullish trade, we target the next pivot point, R1, as a profit target. Now let's look at the signal on the S&P 500. As usual, first you must identify the towered top candlestick formation, which is right here. Green candle, consolidation, and the aggressive red candle. Location of the signal is also perfect, right at the central pivot point. Like any other support or resistance area, pivot point levels should be monitored closely when prices approach those levels. They will result in either a deflection or break through the pivot point. In this case, it was a breakout, a continuation in our anticipated direction. Stop loss goes above the red candle, and for take profit, we'll set it at S2, not S1, because if we plan to exit at S1, we would have a bad risk-to-reward ratio. If you plan to exit not at the first pivot, but at the second one, if the S1 level is reached, to avoid turning a profit into loss, it's better to move the stop to break even, or you could exit 50% of your trade. In this example, the market reached our first target, but failed to reach the second one, and we were stopped out with a break-even trade. It will happen, but at least you're not taking losses. Now, the success rate of this setup will increase considerably if you take trades from key support and resistance levels. If you want to avoid being manipulated and trade from the best levels, you might want to watch this video about the common traps of support and resistance. And check out our Academy program if you want to further level up your trading. Until next time.